my position. I'm a partner with PwC in Jersey, but I also I'm a member of the Global Asset Management Leadership Team within PwC. There's about 10 of us involved with this. And my responsibility is private equity. And the reason that I have that responsibility is because our global firm's view of the island as a centre of excellence for private equity. So a lot of it's down to the people who are sitting in the audience today. It's because of you guys that we are a centre of excellence for private equity. In terms of what I want to cover today, I really just want to remind you again, what were the overall objectives behind the AIFMD, just to put everything in context. Talk a bit about the complexity, just to encapsulate what Charlie was saying around, the Commission, Council, the Rapporteur. What were the areas of contention, particularly in the early directive that was issued in April last year? How have we reacted to the draft within the community? And why do I think that we actually will ultimately demonstrate equivalence, given the opportunity to demonstrate that? Because if we look at certainly the indications from the rapporteur, I believe we tick all the boxes, both in respect of a jurisdiction for funds and a jurisdiction for the location of managers. So I'm very positive today, a lot more positive, I have to say, than I was back in May last year. The initial objectives, I'll slightly contradict what Charlie said, because actually back in 2006, the Commission looked at both hedge funds and private equity, and they were in particular looking at ways in which they could facilitate the growth of that industry in Europe. Within the report on private equity, the Channel Islands were actually identified as a centre of excellence. Why? Because that was the most appropriate place to locate the structure. And the challenge for Europe was how could they replicate that structure to provide the same tax-neutral vehicle that would be attractive to international institutional investors coming into Europe. And I should add, a significant proportion of institutional capital going into alternative investment funds is actually not from within Europe. We have a significant amount of capital that we manage in the island, which is sourced from the US. So the initial objectives were really, I believe, as Charlie said, in response to the post-Madoff scenario. A lot of people lost a lot of money. But I have to say again, in terms of our reputation, I don't believe our reputation has been tarnished as a result of anything that happened within the Madoff scenario. And as importantly, how do we create a branded alternative investment fund management directive? How do we create a brand that facilitates the growth of the industry in Europe? And I believe that was also one of the key objectives within the directive itself. And the last point there was around, after a transitionary period, how do we actually allow third country funds and managers access to the market? In terms of the process, it is very complicated. The ball is initially produced, as I think Martin Power, head of your cabinet, put to me back in June. It's thrown in then to the Council of Ministers, the ECOFIN, and into the Parliament. I think the Council of Ministers has somewhat stumbled under the Spanish presidency. We certainly had some very clear direction coming from the Swedish presidency up to the end of December of last year. And I believe the European Parliament are now actually beginning to take the lead in terms of showing some real clarity around the direction of the directive going forward. And indeed, when I talk about how third country funds and third country fund managers actually will be equivalent, I'm really referring to what the rapporteur has recently produced. The timetable, the original timetable was to have a collective voice, an agreement by July of this year. I think it's extremely unlikely that that will happen. I think it's probably more likely that we will have a collective view sometime in December of this year, but I could be wrong. It will then take 2 years for the detailed legislation to be worked out. So we may see a directive going into domestic legislation in the summer of 2012 or in early 2013. So they're critical dates to remember. Summer 2012 or early 2013. You will then have a transitionary period of perhaps 2 years if the rapporteur's view is correct, and I'll move on to that in a minute. The areas of contention, there are many areas of contention. The one area I haven't got up there actually is business models. There are certain business models that will be impacted by this directive. For example, and I've mentioned this in previous presentations, the secondary fund market, the private equity secondary fund market, the fund-to-fund market. There's a lot of business models that really haven't been catered for within the directive itself. And my hope is that ultimately these business models will be catered for. Depositories. A lot of debate around the original directive, which said only an EU credit institution can be appointed a depository. We've seen a lot of relaxation around that in the rapporteur's version. Incidentally, we also see a carve-out for private equity within the rapporteur version. I think there was a lot of concern within the private equity community. How do you appoint an independent depository on a private equity fund? There's a lot of difficulties associated with that. And indeed, at a meeting with the FSA about a week ago, the FSA also agreed with us that, yes, it was indeed very difficult. But it's good to see that the rapporteur has specifically carved that out. Controlling interest disclosures. Why would a private equity fund be subject to such an increased level of disclosure as against a sovereign wealth fund who operates in the exact same market? The level of disclosure, even within the rapporteur draft, is quite extensive in terms of the level of communication to the employees of portfolio companies. And every time you go through a threshold change of 10, 20, 30, 40% ownership, there's certain requirements. So there is still a lot of, I think, concern in respect of disclosures. The scope, in the original draft, it talked about if you were a leveraged fund, or a manager rather, you would look at the collective funds under management, and if they were over 100 million, you were subject to regulation. If, however, you were a private equity manager, typically a closed-ended structure, non-leveraged, it was 500 million. In the rapporteur draft, that has been removed, and we're now beginning to see specific sector carve-outs. So I'm quite hopeful for real estate, for example, who have yet to really engage on this topic, that we will start to see carve-outs specific to the industries. Third countries, obviously something that's very close to my heart. Again, I've seen a lot more clarity coming through from the rapporteur in terms of what the requirements will be. And I believe in going through those requirements, we can tick the boxes. So I'm very confident we can actually be an equivalent jurisdiction.